Mr. Shivakumar G, CFO of G Shipping, joins us now, and I just want to set the context here. If one really looks at what is happening to the shipping market per se, well, broadly you could divide it into two or three large categories. You could look at the dry bulk, you could look at crude, and you could also look at gas. The trend is that, and I'm looking at last 1 year, the crude carrier, the time charter yield per day has gone from 10,000 to 33,000, but in dry bulk, it has come down from 30,000 to 21,000. Why is this phenomenon at play? What does this mean for a company like G Shipping? And freight rates are often an indicator of the economic activity. So how should we look at the freight rate complex now going forward? Mr. Kumar, good morning. Thank you for joining us. There is a huge uptick in the crude carriers, and there is a big drop in the dry bulk. Normally shipping rates, they tend to move together in tandem with each other. Why this year it's been different?
Actually, no, they don't really move in tandem with each other unless there is an overall, economic boom like happened between 2003 and 8. So they tend not to move together in cycles. What's happened in tankers, and it's not just crude carriers, it's also product carriers, is the disruption caused by the war in Europe, which has resulted in changing of the trade routes, therefore making tanker shipping inefficient. Basically, the same number of barrels of oil or slightly more barrels of oil traveling from much longer distances, which means you need more ships to do the same amount of work. What we call ton-mile demand. So ton-mile demand has gone up very significantly, and that's what has tightened the market for both crude carriers and product carriers. In dry bulk, it is a drop in actual demand, the tons carried. Dry bulk depends a lot on China, Chinese demand, and we all know that Chinese demand has been a little bit subdued in this year because of their situation with regard to COVID lockdowns, etc. And therefore, dry bulk has been quite weak in this year as compared to the previous year. Now, whether this releasing of the COVID lockdowns helps bring back that demand is something that we'll have to see in the next quarter or two.
As you look into the future, since the charter rates are often used as an indicator of economic activity, do you expect dry bulk rates to move higher and the gas and crude charter rates to come lower?
Prediction is always fraught with risk, especially in our business. We don't know what the markets are going to do. We know how the fundamentals are lining up. The fundamentals are lining up like this. For dry bulk, the first quarter of the calendar year, Jan-March, is typically the weakest period in the year. And therefore, unlikely to be very strong in the next quarter. However, as I said, China reopening might be a good play, which results in some recovery in that market. On the tanker front, the reopening play across the world and the normalizing of oil demand, especially if oil prices have come off, might result in higher demand and therefore rates to remain reasonably strong. Maybe not as strong as they are today. They are exceptionally strong currently across the board. Maybe not as strong as they are today, but still at very profitable levels. Just to point out, we are significantly higher today on crude tanker rates than we were in the last quarter. So the ships that earned $35,000 in the last quarter are probably earning $55,000 a day. So it's significantly higher. Product tankers continue to be where they were in the last quarter. They averaged about 35. They're probably somewhere in that range now, between $35,000 and $45,000 a day. So it's tough to predict, but the one good thing is that the order book for tankers is extremely low. It's very low for bulk carriers also. It's the lowest it has been in the last 25 years. And the order book basically is the overhang of future supply coming into the market, which is always a worry. That is exceptionally low. And as I said, the lowest since we started looking at data in 1996. So that's one positive factor for us and for the markets.
So if one has to understand the predictability based on freight trends, you've said that look, forecasting is always a dangerous business, but fundamentals right now are stacking up. So, where are the fundamentals of your non-shipping business? How are they stacking up? I'm basically talking
Yeah,
about the oil rigs. I mean, is this a bumper
yeah,
time? What's given what's happening to crude prices?
yeah. Certainly in recovery mode. Uh, from the lows of 2017-18, that was a very, very low market. It was a terrible period. And the markets, the oilfield services market has gone through a terrible times from 2015 to 22. It's been in recovery mode for the last 12 months or so. We've seen rates going up very significantly. Already from the bottom, we saw pricing go up by about 50 to 60%. Of course, that was a very low bottom. We've seen recent pricings in the international market being at least 100% above what they were a year and a half ago. That's the day rate pricings. We haven't seen a recent pricing in the Indian market for jackup rigs. We hope to see that within the next month or so, because there is a tender actually which is under discussion. And that will tell us what the benchmark is like. Certainly, it's going to be higher than the last pricing that we saw about a year ago, and back to profitable levels. So the fundamentals for that business, at least the demand side fundamentals, are looking quite good for the oilfield services business. In the international markets for the supply vessels, certainly rates have gone up. They've probably also doubled in the last year or so. And we know that because we have vessels operating in West Africa and in Southeast Asia.
Right. Mr. Shivakumar, that of course was all the academic, knowledge. Now let's try and understand what the market really wants to know from GE Shipping. You've become net cash on your books for the first time, I understand, last quarter, mainly because of the sale of 2 ships that you did in the first half. Considering the high demand now for older ships, especially the oil tankers, would you be selling any more this fiscal or next?
It's tempting. The prices are tempting. Again, we'll have to measure that against what can we earn by holding on to the ship in a strong market. It's possible, and these markets are moving quite rapidly. So we might suddenly come across a tempting price and sell. We don't think we'll be selling much really, because we'd like to hold on to most of our capacity. And as you said, that we are net cash, so we are not at our optimum leverage. We need to have leverage in order to make those returns. We don't have leverage even to the markets. So we might sell, but not too much. We are currently at 43 ships. We'll look at selling maybe, but that's not going to be a big driver going forward. Operating cash flows are exceptionally strong, and that net cash due to the sale of ships, it just brought it forward by a month or month and a half because the operating cash flows themselves are so strong.
So what will drive the next leap of growth for you? Is it going to be China opening up, economy picking up, crude falling further, or is it going to be via the more acquisition kind of route?
Yeah, so 2 things. One is on the rates that we earn on our ships, and that will be, with regard to the world normalizing. So China as a big consumer, not just of dry bulk commodities, but also of oil, coming back to normalcy, and therefore oil coming back to normal trend level of growth. That will drive the tanker markets potentially to remain at current levels, or at least at strong levels, and also dry bulk. So that's on the rates. Now coming to our capacity, and that we try to be disciplined value buyers. We have gone net cash, so we have a lot of capacity to expand. We will look for opportunities to do that. However, we will expand only at levels that make sense, that give us a reasonable margin of safety. So we will wait for those opportunities. We are not yet seeing those prices. If we get those prices, we will certainly move, and hopefully we will move to acquire in for a significant amount of money. We'll wait for the right prices to come before we acquire. It's something that we want to do, but we want to do it only at the right price.
So Shivakumar, morning. You spoke about the order book for tankers being fairly low. I just want to understand, what does the current order book to fleet ratio look like? And do you think that we are likely to see a supply overhang going forward?
The order book to fleet ratio is at between 4 and 5% for crude and product tankers both. Typically, this has been on average about 15% over the last 25, 26 years. And therefore, there is no supply overhang. We've also seen very little scrapping happen over the last 6, 7 years. So there is, in fact, a scrapping overhang for the market, which forms a little bit of a safety net. So if you have a very weak market for tankers, you could have some scrapping kicking in, which means that supply gets taken out and the markets get back into balance sooner. So it's actually a positive for us. There is very little supply overhang from the order book.
Right, and recently actually we spoke to JNPA. They said that they're investing quite heavily in creating capacities. With this regard, I'd like to know your plans as well for entering the container ship segment. Is there anything on the cards?
Nothing on the cards for now. It's something that we'd like to do in the long term. Again, it's premature to discuss it because it'll take some time for us. We need to get to grips with the business dynamics and everything. We need to get the right opportunity to enter the business. So while it is something that we would like to do eventually, we are not really close to doing anything there.
So let's summarize our today's interaction. I mean, it's a rarity for us to get you on the channel, so I'm going to take the liberty of asking one more question. There is one side is China, which we don't know where that demand is moving. On the other side, there is a slowdown which is having impact on exports. But the joker really is going to be what happens to imports and domestic demand. If you have to put all these factors together, do you see the business which you represent, which is shipping, is that business in a 2 to 3 year or 3 to 5 year uptrend?
Typically, cycles haven't been, uptrends and up markets haven't usually lasted for 3 years plus. It's very rare. We had that one so-called super cycle that we had from 2003 to 8, but that was, a tide that lifted all boats across all industries. Typically, up cycles last for 1 to 3 years. So because then you get ships getting built and then the supply comes in and then the market comes back into balance. So it's not really, it's tough to expect a 3 to 5 year upcycle. Having said that, it's really tough to predict in this business, and and if you have a rapid normalizing of economic activity, you could have a very strong cycle for 2 to 3 years at least.
Mr. Shivakumar, great to have you on the show today. Thank you so much for taking the time out and speaking with us today on ET Now.
Thank you. Thank you.